Hi, Tony Puente, Fairchild Partners. Great to hear how CCM continues to provide education, sponsorship for the RPAC, scholarship opportunities for individuals all around the country and locally here. I feel like I'm living proof of benefiting by being a CCM designate since 1998 and benefiting from all of those above features. So again, very proud of what CCM has done and what we're going to continue to do. As many of you may be asking, the presenters today will be having slides and pictures. All of it is uploaded now on our website and you have access to it, flccim.com, flccim.com. We're going to be covering the 4 market segments today. The capital markets will go first, then we will have retail, the office market, and also the industrial market as the 4th segment for today. Super excited and looking forward to all of these presenters. Our first speaker today, we're very excited about, Melissa Rose. She is the Capital Markets Managing Director for JLL. Been in the industry since 2003. She's prior to that, she was Managing Director for Ackman Sif. Has experience in the in New York and in Miami, representing principals and families in terms of their investments and their opportunities. Melissa, go right ahead.
Hi, everyone. I want to thank CCIM and their sponsors, Commercial Edge by Yardi and the University of Miami. I'm so happy to be here today speaking with you, and I want to thank everyone that's joining us virtually. Today, I'll be sharing a high-level overview of 2020 and some of what to expect in 2021 regarding the availability of capital for commercial real estate, but from both an equity and debt perspective. We'll also touch on factors contributing to an increase in investment, specifically in the South Florida market. The impact of COVID-19 on the global economy and CRE industry has been substantial. With our recovery being heavily reliant on the administration of the vaccine as well as political factors, there's still quite a bit of uncertainty about how long growth will be constrained. That being said, there have been several silver linings in particular property sectors and geographic markets. In slide 1, you guys can see that recovery is apparent based on deal volume changes. So year over year between 2019 and 2020, we'd see about a 35% reduction. The slide shows 40 because it was as of the end of the quarter. But if you look at Q2 versus Q3 in 2020, there's an increase of about 31%. Some of that I would attribute to some increased sales volume caused by some uncertainty around the 1031 tax exchange, but I think it's illustrative and positive that we will see deal volumes rebounding and increasing in the year to come. This growth is supported by nearly high levels in liquidity in the debt and equity markets. The next slide illustrates that the U.S. has dry powder that exceeds $205 billion, and there's about $340 billion of global capital that's sitting on the sidelines as well, which is one of the largest factors that's supporting our potential growth in the next year. The current investor universe for real estate is broad and expanding. So it includes institutional capital, family offices, private investors, and cross-border capital or foreign investment. As you can see in the next 2 slides, which are really exciting, we're expected to see increased allocations from both institutional capital as well as family office capital being allocated into real estate. The prevalence of institutional capital experiencing a secular increase is expected to jump by 2025 to 11%, which is quite significant. Part of what, one factor that the allocation of growth has supported is the low interest rate environment is moving investors out of fixed rate products that are lower yielding, and they're searching for fixed rate surrogates, and real estate is a great defensive alternative for both institutional and family office capital. In the next slide, where we're looking at family offices in a deeper dive, you can see that most of these family offices have been established after 2000. There's about $10.2 trillion in average wealth of billionaires supporting these family offices. Currently, we're seeing an allocation to real estate at 14% and fixed income 17%. I think it's likely that we can see a lot of the fixed income allocation be reallocated into hard real estate assets in the years to come. Cross-border capital investment has been a little more challenged than these 2 other areas. According to Real Capital Analytics, as of the 3rd quarter of 2020, it was down about 70%. While currency hedging costs are aligned very nicely with low interest rates, it's been challenging for foreign groups to come see real estate assets with travel restrictions related to COVID. And there's also been less large trades. So we typically see CrossBorder Capital investing in larger assets, of which there's just been less on the market in 2020. I think with the favorable interest rate environment and tailwinds behind us, potentially travel restrictions being lifted, we'd like to see more foreign investment, and we'll likely see more foreign investment entering the real estate market in the years to come as well. Even with transaction volume being far below pre-pandemic levels, mortgage originations only sustained a loss of about 35% this year. Most interestingly, the agencies remained fairly flat year over year between 2019 and 2020, having a large allocation of their lending into the multifamily space. Commercial banks probably took the biggest dip at 44%. The positive news is that we're seeing the debt markets be back to close to pre-pandemic levels, incredibly active in all property sectors, including those that are perceived as having trouble, such as office, retail, and hospitality. The darling asset classes of 2020, like industrial and some portions of the multifamily sector, have actually experienced probably record low pricing. Part of that really attractive pricing is also causing some cap rate compression in many of these property sectors as well. Price discovery is still underway for office, retail, and hospitality. Over 2020, we saw discounts of 0 to 20%. I think we'll have some more clarity in those spaces, but we're many investors that are looking for more yield and believe that we're going to have a reversion to the mean, and that people are going to get back to their normal lives and back to traveling and sitting in offices and being collaborative, are making bets on those asset classes that will hopefully be successful ones. With the availability of debt capital for those acquisitions, I'd like to hope to see that we're going to have more activity in those sectors as well in the year to come. Alternative asset classes have also come into focus and have become an area of interest. So if you look at the next slide, as yields for core properties types have compressed, we've seen some growth and expanding interest from all capital sources into asset classes such as single-family rentals, healthcare, senior housing, data centers, and self-storage. I would add to that list specifically cold storage warehouses, a niche portion of the industrial market. We've seen online retail purchases jump from about 11 to 16% during the pandemic. And some of that consumer behavior has also translated over to the way people buy their groceries, which is the food suppliers are the largest portion of the food suppliers. Occupy quite a bit of the cold storage space, as well as pharmaceutical companies and drugs and life sciences growing as well, and several products that we need to keep cold. You all guys know I'm sold on the cold. Another really interesting property sector that we've seen some growth in, it's pretty significant year to date, it's barely down year over year from 2019, is the life sciences. Another trend we're seeing emerge because of the broadening interest among investors diving into this asset class is just some conversions and development properties that are now being identified as potential life science uses to accommodate the growing demand. In closing, I wanted to talk a little bit about how all of this is affecting our market specifically. So I think Miami's economy in a post-COVID world is poised for a significant amount of growth. So we have a confluence of factors that I think are helping sustain that. We have, Latin American migration capital has always been here and I think will continue to be. We have a very favorable tax environment, which has allowed us to become the benefit of a lot of domestic migration from both the Northeast and California. We have definitively emerged as the Wall Street of the South. You guys can't escape the headlines about JP Morgan, Goldman Sachs potentially coming into the Miami market, and groups like Elliott and Blackstone, taking significant space and a bet on our market. Aside from the large employers, I think we have fantastic weather and lifestyle that's attracting a diverse pool of talent to support these new businesses. And we have an expanding innovation and startup ecosystem, which is really attractive to both tenants and renters and buyers that want to live and play and work in South Florida. I want to thank everyone for joining us today. Some of the groups that I cited were Real Capital Analytics and the Mortgage Banking Association, and I want to thank our sponsors again. And I have a positive outlook for 2021. I hope all of you do too, and I look forward to seeing you all in person soon. Thank you.